This is Mark Sobel. I'm the U.S. Chair of OMFIF. Today, for OMFIF's last segment of Fed Week, I have the great honor and privilege of being joined by Eric Rosengren for a financial stability discussion. Eric Rosengren is President and CEO of the Federal Reserve Bank of Boston. Appointed to that position in 2007, he joined the Boston Fed in 1985 as a research economist, and in subsequent years headed the research department's banking and monetary policy section, and later the supervision and regulatory department. There are few people with such experience in covering the waterfront of U.S. monetary policy. Welcome and thank you. Eric is going to lead us off today with a short presentation on financial stability. He and I will follow that up with a discussion, and then we'll turn to audience questions, which can be submitted via the Slido function to the right-hand side of your screen. Eric, thank you greatly for joining us today. The floor is yours.
Well, thank you very much, Mark. And I am going to start with a slideshow, in part because I very much like to talk about data and like to start a discussion grounded in data. So I will give a very high-level overview of some of the issues that I've been thinking about regarding financial stability. And in the conversation with Mark prior to just getting on, we were highlighting how good it was that Mark had one session that wasn't just on monetary policy, but was on financial stability, because I actually do view it as a critical component of central banking and one that probably gets a little too little attention. Next slide, please. So there are going to be three areas that I want to talk about today. The first is going to focus on something that's been a problem in the last two recessions, and that is that both the great financial crisis and the pandemic began with bad disruptions in short-term credit markets. And that was exacerbated by a series of institutional issues that I think still continue to today, and I'm going to argue actually are potentially getting worse. And what I'm going to emphasize is the role of money market mutual funds. Money market mutual funds are more prevalent in the United States than they are in Europe, though they do have a presence in Europe. They have a fixed NAV in the United States, and which means that when we start running into difficulties, and people start withdrawing funds, it starts seizing up many of the short-term credit markets. And it was a problem the last two recessions and has yet to be addressed. But it's not just the money market mutual funds that had issues during the pandemic. There are a lot of other cash management alternatives that I'll briefly turn to and highlight that they had some of the same problems, even though they have a somewhat different structure and have a somewhat different regulatory framework. And then I'm going to talk a little bit about Tether and some of the so-called stablecoins and argue that they have some of the same characteristics that the prime money market funds do. And as a result, potentially are a source of financial stability concerns going forward, as this is an area that's growing very quickly. Next, I want to talk a little bit about the need for the emergency lending facilities and the regulatory changes that occurred during the crisis. So I was very supportive of all the extraordinary actions that were taken. I think they were necessary, they were required, and they're the reason why we're expecting very strong real growth in the United States this year. Monetary and fiscal policy certainly help make sure that the economy is moving forward. And the FOMC at the last meeting is expecting, or at least the median of the people in the FOMC had real GDP at 7%, which I think is probably a good estimate for what real GDP growth will be over the course of this year. And that's largely because of the many actions that were taken to make sure that the economy would pick up. But I would say that one of the reasons that this was needed was there was a great deal of uncertainty about how much credit availability there would be, despite all the regulatory reforms that have occurred over the last decade. And I'm going to argue that, again, we need to rekindle our efforts. I'm going to argue that we should have a countercyclical capital charge, and we need a less ad hoc approach to these crises, need to think more systematically about how we can make sure that credit's available and not only to the largest institutions, but many of the small and medium-sized enterprises as well. And then I'm going to finish my talk with a possible risk in housing. And the reason I'm going to highlight housing in the United States in a very low interest rate environment, the housing prices around the United States have been going up very rapidly, including in places that are less traditional places that see prices rise quickly. In the New England district, where I'm headquartered, places in Maine that tend to be fairly sleepy are now seeing a price appreciation that's quite substantial. Same on Cape Cod in Massachusetts and in Western Massachusetts. These aren't markets that normally show exuberance. And so it just highlights, I think, that we have to think about some of the side effects of a low for long strategy. And that low for long strategy has good macroeconomic intentions in terms of making sure that we get a sustainable 2% inflation and that we get back to full employment as quickly as possible. But real estate around the world has played a significant role in financial instability. Many of the crises that we've seen around the world have been tied to real estate prices going into a boom or bust cycle. And while I'm not predicting that that's the situation right now, I think prices are going up rapidly enough that it certainly bears monitoring and something that we should be thinking about going forward. Next slide, please. So this first slide is just looking at the spread between commercial paper, which is basically short-term debt of high-grade corporations, and the 3-month Treasury yield, which is default risk-free. And the reason I show this is because in short-term credit markets, during normal situations, many of these spreads stay quite low. And I'm just using this as an example, but I could use a CD rate, I could use other commercial paper rates. A lot of short-term interest rates trade quite close to the Treasury under normal circumstances. But there are those periodic times when we have a significant disruption where that spread gets very large. And you can see around the 2008 and the financial crisis that those spreads got very large. And this is for A1P1 paper, so that is the most highest credit quality of the commercial paper. And the second is during the pandemic. Now, when we see these spreads spread to the degree that is shown in this chart, it has implications for much lower prices for the assets. And that poses a problem for many of the short-term credit markets. Next slide, please. And as I mentioned in my opening remarks, one of the areas that's highly dependent on these short-term credit markets, and short-term credit markets are highly dependent on these organizations, are money market funds. So there are two kinds of money market funds that I'm going to focus on. One are government money market funds, and government money market funds are shown in the dark blue. As you can see, they've been growing, and they tended to grow around each of the crises that we saw. People tend to run towards government money market funds in a crisis. So the government money market funds are buying basically short-term Treasury securities under the requirements of the SEC. They can't hold longer-dated Treasury securities. So it's a default-free, relatively low-risk security that's held in government securities. The second kind of money market fund is the one that I want to focus on, is the prime money market fund. The prime money market funds provide a net asset value of 1, which means that if you redeem shares, you can treat it almost like a checking account. In fact, many of these prime funds have checking account features in their retail money market funds. And you feel pretty comfortable using it pretty much like a checking account during normal times. But then there are the times that we have a serious situation in financial markets. And around the Lehman failure was one such instance. So as I showed in the previous chart, the spreads got quite wide. And what happened is when the spread gets wide, the price goes down. When the price goes down, it's hard to maintain the net asset value of 1. And people start pulling their funds out of money markets. And when they pull their funds out of money market funds, particularly the prime funds, it means that commercial paper that businesses depend on don't roll. It means CDs that banks depend on don't roll. It means municipal securities that municipalities depend on don't roll, which becomes a financing crisis throughout the short-term credit markets. So in response to that, the Boston Fed ran a program, the AMLF. It in effect was a bailout for the prime money market funds. As you can see, there was a sharp drop right around the Lehman failure, and then it bounced back, and it bounced back pretty reasonably. Then over the course of the recovery, the SEC adopted some new reforms, and it's briefly described in that footnote, and I won't go into detail. Those reforms, though, put gates and fees on that actually increased the risk that people would want to run from a money market fund. This was predicted by Federal Reserve officials in 2014 in both comment letters and Wall Street Journal op-ed piece that highlighted that it's still an unstable system. And in fact, unfortunately, that turned out to be a very accurate prediction. When the pandemic started, once again, there was a disruption. You saw the spike in the previous chart. The result was that, particularly on the institutional side, there was a run on money market funds. And once again, the Boston Fed had to set up an emergency facility in order to stabilize financial markets and stop the run. Government funds have picked up. That's partly because they are more secure during a crisis. It's also because in a very low interest rate environment, they're relatively more attractive towards prime funds than they would be at other times. But the result has been that money market funds have been a critical feature of the financial crises that we've seen in the last decade. And this is a problem that has yet to be resolved by policy. Next slide, please. Now, there are other types of organizations that are very similar in short-term credit markets. Short-term investment funds and ultra-short bond funds have some of the same characteristics. They don't have the same regulation, but as you can see, while the prime money market funds have been coming down, there has been some growth in many of the areas of short-term investment funds and in the ultra-short bond funds. During the pandemic, I was getting calls from managers of both ultra-short bond funds and short-term investment funds wanting to get access to our facility because they were experiencing the same runs that many of the money market funds were experiencing. So solving the money market fund alone is not going to be sufficient. These other funds tend to be more in a general mutual fund organization. And what it highlights is if there's a mismatch between liabilities and assets in terms of maturity so that you can pull out your funds immediately, but you can't necessarily get the same value out of the assets during a crisis, it creates a problem for these types of organizations. One solution to this that's being considered is swing pricing. I don't have enough time to go into detail about what swing pricing actually does, but it in effect provides a penalty for investors if they decide to withdraw their funds during a crisis. And there are European funds that did invoke this during the pandemic. In the United States, while it's allowed by the SEC, it's not widely deployed. There are some institutional reasons for that. But I think we need to take a fresh look and think about these other funds as well and make sure that not only the money market funds become more secure, but really any of the organizations active in our short-term credit markets. Next slide, please. Next, I want to talk very briefly about stablecoins. And stablecoins have been in the news recently because there was one of the stablecoins last week ran into financial difficulties and basically collapsed. And this shows you stablecoin capitalization relative to prime money market fund assets under management. Why I want to highlight this is it's basically showing exponential growth in the stablecoin market. And there are many reasons to think that stablecoin, at least many of the stable coins, are not actually particularly stable and actually have some of the same features as money market funds. The difference is prime money market funds have been losing market share, but these stable coins have been growing very rapidly, in part because of their use along with the cryptocurrency market. Next slide, please. So what the largest of the stable coins is Tether. And this just provides a breakdown that Tether's provided. And while they talk about being stable, if you look at the set of assets that are there, it includes corporate bonds, secured loans, commercial paper. In effect, this is a very risky prime fund. Prime funds would not be able to hold all these assets. They certainly wouldn't be able to hold precious metals or longer duration securities. And the prime funds have gotten into difficulties in the last two recessions. The stable fund that has this kind of characteristic, in effect, looks a lot like a prime fund. And so it's not going to be stable during those times when we see spreads gapping out in a significant way. And so this is a feature that I think is important because it's such a fast growing part of the market. So while prime funds were able to be very disruptive, they're not growing at a rapid rate. In fact, government funds have become much more popular recently than the prime funds. But these stable coins are becoming more popular. There are other reasons for that. But I think there's a financial stability concern that a future crisis could easily be triggered as these become more important sector of the financial market, unless we start regulating them and making sure that there's actually a lot more stability to what is being marketed to the general public as a stable coin. Next slide, please. So I want to shift gears now away from the short-term credit markets, which have been a feature of the problems in the last two recessions, and focus on some of the actions that we took as a result of the pandemic. And this is really focusing on two things. First is regulatory relief. So this slide just highlights a variety of ways that we did regulatory relief in order to ensure that the banking sector would continue to be able to fund small, medium-sized, and large businesses. And that included allowing lenders to do loan modifications without classifying the loan as troubled debt restructuring, making a number of changes that made it easier to satisfy capital ratios so they could continue to lend without having capital constraints, encouraging banks to use capital buffers, and the suspension of share repurchases and limitations on dividends. So these were all actions taken during the pandemic. I strongly support those actions, but the reason we needed to do those actions is we weren't fully confident that credit would be completely available during the pandemic. That's something that I think we need to work on. Ideally, we don't need to be changing the regulatory apparatus in the middle of a crisis because we have more automatic stabilizers than we currently have. Next slide, please. As well as changing the regulatory framework to make sure that banks were going to continue to lend, we did emergency lending facilities. Some of these facilities were the same type of facilities we did during the financial crisis. Some of these were brand new facilities. So I've already talked about the money market liquidity facility. And some of the emergency facilities were really designed to deal with the problems that were really occurring in March and April in financial markets that were reflecting the bad disruption that we were seeing in short-term credit markets. But this time around also, the Federal Reserve reached further into the economy. And some of the programs were done by the federal government. Some of the programs were backed by the federal government and done by the Federal Reserve. Potentially the most important ones were the Paycheck Protection Program, which provided forgivable loans to primarily small businesses, and the Main Street Lending Program that provided loans to medium and larger firms. And then finally, we had two facilities focused on the corporate bond market, the primary and secondary market. These actions were taken again because we were worried that funding would evaporate for a wide sector of the US economy. And as a result, we would have a much more severe recession. Once we announced these programs, the credit spreads got much more narrow. Many of these programs didn't have to do a huge amount of lending because the markets recovered fairly quickly. And many of the programs were designed so that as markets stabilized, you didn't have to, the programs weren't that attractive. Next slide, please. This just highlights the Paycheck Protection Program and the Main Street Lending Program. Why I want to emphasize this is you don't do this if you think that the banks are going to be fully able to provide financing to the corporate sector. And so there was a great deal of concern that the corporate sector was not going to get sufficient financing. Now, I think the Federal Reserve programs, with their announcement, actually help very large firms in a very significant way, in that the spreads came down very quickly. But as you get to smaller and mid-sized firms, the problem becomes credit availability. And credit availability is a very different issue than the cost of credit. And both of these programs, one designed primarily for very small firms, it's an expensive program because these were forgivable loans for the Paycheck Protection Program, required an act of Congress to be able to do it. And the Main Street Lending Program was a part of an act of Congress as well, which was a lending facility, again, done by the Boston Fed. Next slide, please. Now, this shows you this commercial and industrial lending. So these are the normal business loans, not backed by real estate. And it just shows you what the C&I lending was overall and what it would be if you exclude the PPP program. And what it highlights is that a significant amount of the lending that was occurring in the midst of the crisis was occurring in the Paycheck Protection Program. Now, it may be that banks would have done some of this lending otherwise, but I think one of the concerns of policymakers was it wasn't clear that that would actually happen on its own. And I can tell you from a large number of conversations with businesses that they were very concerned that credit would not either be available at all or not on terms that were commercially viable for these organizations. So the need to intervene in markets at this time to this degree highlights that we aren't fully confident that banks have enough capital and a willingness to lend when we get these kind of severe economic outcomes. Next slide, please. Now, on the large firm and large bank side, I think our programs are very effective. So with the announcement of the corporate bond programs, the spread came down almost immediately. And what's interesting is I'm highlighting the months in the midst of the pandemic in the United States when the markets have basically frozen. And what you can see is investment grade issuance actually was occurring during this time, so that the spreads came in so quickly that investment grade firms were able to issue new debt. And I would highlight that high yield bond issuance didn't evaporate either, that there was an ability to continue to do high yield bond issuance during the midst of a severe pandemic where there was a broad shutdown in the US economy. So I think our programs do a very good job of reaching the various large institutions. I'd say we have a mixed result in being able to do that for small and medium-sized organizations. And one of my real concerns is if we continue to have to intervene to this degree in markets, we're going to have a much more concentrated US corporate market go over time, because it means that the liabilities of large firms are going to be refinanced, while small firms and medium-sized firms will disproportionately, in these kind of downturns, have economic viability problems. Next slide, please. So switching away from the crisis and what we could do about it, I just want to highlight one financial stability concern going forward that's a more mundane, but nonetheless pretty important. So I was actually hoping to have a slide that would differentiate between urban, suburban, and rural, but we didn't get that work quite done. So this is using the Case-Shiller information for major markets around the United States. A couple things to note. One, in many of the major markets in the United States, metro area housing prices are already higher than they were during the period leading up to the financial crisis. The second I would note is if you look at the top row at Boston, Denver, and LA, rather than that line starting to level off, that line is going straight up. This is the wrong time in the cycle to have housing booms that actually could go bust. So I'm not forecasting that will happen, but I would say that real estate has been the source of financial stability problems in the United States during the financial crisis, during the Great Depression, and at other times as well. In New England, we actually had a mini problem with commercial real estate and residential real estate in the late 1980s. So around the world, Banking crises and financial stability periods are frequently tied to real estate. It's a widely held market. It is more prone to boom and bust in many countries. And so I think this bears watching and is a potential side effect that I think we actually have to be thinking about as we think about what appropriate monetary policy is going forward. Next slide, please. So to conclude, short-term credit markets have been badly disrupted in the last two recessions. As I highlighted, I think there are a number of institutional things that we need to do in order to make sure that the next crisis is not having another disruption in short-term credit markets. Second, I would highlight that we took very significant action during the pandemic to make sure that we could support lending. I disagree with some who argue that we had a sufficiently capitalized system, banking system, because if that were necessary, we wouldn't have had to pull out all the stops to make sure that lending continued. So I think we have to be less dependent on ad hoc measures. And I think a well-designed CCYB, which is a counter-cyclical capital charge, which builds up capital buffers during good times, gets released when we have bad economic times, would have made at least some of those measures less necessary, because there would have been a natural way to provide a lot more capacity for banks to continue to do their lending. In terms of the emergency lending facilities, again, I think they were very important to do. I think they were highly effective, but they do disproportionately help the large firms. This time we did focus more on small firms with the two programs that I highlighted, but nonetheless, I would say that bankruptcies among small and medium-sized firms were much more likely than large firms, and many of the programs were designed to provide support, but you couldn't refinance your entire liability structure as a small or medium-sized firm. For large firms, they were able to refinance into lower cost financing, which basically changed their entire balance sheet. So if we continue to have these kind of crises where these kind of interventions are needed, I think ultimately it's going to result in a greater concentration than we want in the US economy in the corporate sector. Finally, I just highlight that housing prices in the United States have been going up quite quickly. And this is something that I think policymakers need to continue to monitor very closely and think about what the ramifications would be if we create a boom and bust cycle this time around. Thank you.
Well, thank you for that excellent presentation. Let me just pick up off of housing. The Fed has recently inaugurated financial stability reports. I'm a big fan. I think they need an editor with a little literary pizzazz, but beyond that, it's a good report. And it points out that valuations for some assets are elevated and could be vulnerable to significant declines. So you mentioned housing prices, others look at stocks, you look at the tethers and the Bitcoins, and they're warning of market froth due to a reach for yield amid the zero lower bound. You referenced this. So, and there's a worry if risk appetite falls, there could be huge disruptions for financial stability in the economy. So, just a very general question, how worried are you about froth in US financial markets right now?
So one of the consequences of a very low interest rate policy is that if you do a present discounted value and you have a very low interest rate, the valuation gets very high. So part of what we're seeing in very high valuations by historical standards reflects the very low interest rates, particularly the very low long-term interest rates that we're seeing in the markets right now. So part of that is the result of the severity of the recession and the Fed's reaction to the severity of the recession. So it doesn't surprise me that we have high valuation. But I would say that I do worry about froth in markets, and I do worry about individuals assuming that monetary policy is going to stay accommodative forever. And what that results in is people taking on more risk that once interest rates start to rise, those valuation measures are going to change. More than likely, it will be harder to get the same returns in stocks and in housing prices as we've had recently as we start getting to the situation where it's appropriate to raise interest rates. So I do worry that if we're not careful, we can create a situation where rather than getting back to full employment, we lay the conditions for not getting to full employment because we have another downturn much sooner than we would otherwise want. Again, I'm not expecting that. I don't think it will happen, But one other thing that I would highlight, since this has both a UK and a US audience, we don't have the same financial stability structure that the UK has. The UK has a much more integrated structure. There is a governance structure that's very focused on financial stability. The US does not have the same set of tools, and it doesn't have the same governance. So the FSOC structure that we have in the United States really is not designed to think holistically about what are the challenges to financial stability. So while we can worry about this, and while many of my colleagues talk about using supervisory powers, many of these problems are not necessarily just in the banking sector. We really need a much more integrated financial regulatory structure if we really want to deal with financial stability concerns in a systematic way. If we don't do that, then it means that monetary policy may not be able to continue to be as accommodative as it otherwise would be. So that I do think that in the absence of other tools, you have to think about the side effects that very easy monetary policy has. You're on mute, Mark.
Thank you. You're somewhat anticipating all my main subsequent questions. The Fed has a dual mandate. It has financial stability responsibilities. As you've described, financial stability disruptions can impact the Fed's ability to pursue its dual mandate. We saw that in these crises. Ideally, one would wish to be able to separate monetary policy from financial stability concerns. It's said that we need strong micro supervision and macroprudential oversight to do that. But as you were just suggesting, America's macroprudential policies are a work in progress. And then the financial stability ructions often come from non-banks, as you've described, from money market funds, for example, that are outside the Fed's remit. And many question the adequacy of the so-called activities-based framework for examining non-banks. So this leads me to two questions. Let me pose the first one. Can financial stability concerns truly be separated from monetary policy decisions? And does the Fed need to increase the weighting of financial stability concerns in its reaction function?
Ideally, we would have the tools to treat monetary policy separately from financial stability. And so if you're a country that has the ability to both use macroprudential tools for the banking sector, but also for the non-banking sector, which frequently includes things like in the UK, you have limitations on how much debt individuals can take, for example, for housing. We don't have those same powers in one centralized authority in the United States that's doing it primarily because they're concerned about financial stability rather than other reasons for why there might be problems. So without adequate tools, it forces you to use the monetary policy tools that ideally you'd like to focus in the United States on the two dual mandate, the full employment and inflation. But in the absence of other tools, really the only counter-cyclical capital charge is really the only tool that we have in the United States that's truly macroprudential. Some people think of the stress test as macroprudential. I do not. It primarily focuses on the ability of large institutions to stay solvent. Macroprudential is really making sure that lending continues when we get into an economic downturn, not just that large institutions stay solvent. So I think that we have to really deal with financial stability and separate monetary policy from financial stability. We would have to think very differently in the United States about our current structure. It's pretty fragmented in the United States. No one really is responsible for financial stability. I think many people in Congress and the general public think that we do have more financial stability tools than we actually do. And I think that that is a problem because when we get into a crisis, it forces us into a situation where we're doing the kind of lending facilities, again, that I was highly supportive of doing and think were critically important. But ideally, we'd have a structure that we don't have to keep doing this during serious economic downturns.
Well, I guess that raises the question about, you've said we need a stronger macroprudential framework. I assume especially for non-banks, which are outside the Fed's remit. Maybe you could elaborate on that. And also, do you think that the activities-based approach to non-banks gets the job done?
I think ideally we need an organization that is thinking about financial stability in an integrated way. And that isn't by activity or by institution, it's really thinking about both. And so if we tighten up regulations on banks, at least some of that activity is going to move to non-banks. And if nobody regulates that sector of where the activity is going, it doesn't really, it makes the bank safer, but doesn't necessarily make the system safer. And really what financial stability is thinking about is making sure that we don't have the financial sector causing the real sector more significant problems during economic downturns or during periodic disruptions that we see in financial markets. And so I think we need to, as you mentioned, that the SEC regulates the money market mutual funds, but I don't think their primary focus is on financial stability. The SEC tends to be focused on investor protection. And when we look across the various regulators in the United States, we've partitioned financial markets in very narrow ways, but it's not particularly well integrated. The FSOC was intended to coordinate that, but it doesn't really have strong powers to require a broader financial stability look. So the UK does have a governance to do that. Now, that doesn't mean that they actually use that governance, but I've been generally quite impressed by how the UK structure has actually worked. And I do think that they have done some very thoughtful work thinking about financial stability in an integrated way. So I would just encourage us to think about how we could get a more integrated framework that's not based on activities, not based on institutions, but thinks across markets and thinks about how activity is going to move and how we make sure that it doesn't make both individuals and firms much riskier than they otherwise would be.
That's a good endorsement for the UK Financial Policy Council, which Don Cohn is a member of, if I recall. You just put your finger on it. The FSOC is a coordinating body, but it's bulky. You mentioned the SEC should pay more attention to financial stability, something Dan Tarullo has said. Maybe you could, I think what I heard you saying is you'd like to see the Fed create its own FPC. I was wondering what else. I mean, I've always been surprised that the Fed frets so much about risk from non-banks, and yet when I read the financial stability reports, it doesn't say this is what we need to do, even if it's outside of the Fed's remit. Do you think you obviously want a more forceful role. Do you have more concrete suggestions for how to get there?
The financial stability report itself is a relatively new mechanism to highlight some of the challenges that we're seeing. And I think financial stability is actually an area of economics that's relatively new. When we had such a long period after the Great Depression, where we didn't have nearly as frequent financial stability issues, the result was it didn't get a lot of attention in the economics profession or in the finance profession. But I think after having two big shocks in 10 years, I think people's attitude towards thinking about financial stability is gradually changing. I think the financial stability report, it's hard to be too critical of other regulators who don't necessarily behave differently just because somebody from the Federal Reserve argues they should do something differently. So I think it is important to highlight some of the stresses, but I think we need to find a more integrated framework than the FSOC provides. And I do think it requires a different governance. It could be in the central bank. It doesn't have to be in the central bank. So there are different models across the world. Sometimes it's in the equivalent of the Treasury Department or Finance Department in many countries. Sometimes it's in a separate unit. Sometimes it's housed as a division in the central bank, like it is in the UK. So I think who does it is probably less important than that they have appropriate powers and an appropriate span of responsibilities, that they can actually think about these kind of things in a more umbrella way, and that they actually have the powers, regardless of who does a lot of the microprudential regulation, to say there are other things that we need to think about, and some of the things that you're doing in these set of organizations are having an undesirable impact on the overall economy.
Great. Let me turn to central bank digital currency, since we're getting questions from that. The Boston Fed is taking a leading role in working on the technical design of a possible CBDC with MIT. It's a deeply technical issue. Your colleague Jim Cunha has helped us out at OMFIF. But there are major policy issues. I can understand very well the desire for faster payment systems in America. I've gone through the pandemic without touching cash for months. So let me start off. Just Senator Toomey asked in a recent hearing, I forget whom,
Well, I didn't get the rest of Mark's question. Maybe while Mark is trying to get back on, I can.
Yeah, I think Mark was asking about CBDCs, so I'll go to one of our audience questions about your sponsoring work on CBDCs, which, as we heard about with Jim Cunha earlier in the week. Are there risks in retail DCs that involve deposits at the Fed, and how should we avoid them?
Yeah, so let me expand on Mark's initial comments. So we are doing work on central bank digital currency, and many central banks are doing so. The policy work is being done by the Board of Governors. So I would highlight the role and responsibility of the Boston Fed is to really think about the technical aspects and making sure that once we've decided exactly how it's to be designed and what policy purpose there is for the digital currency, that we understand the technology well enough that we could go to market relatively quickly. So the work that we're doing with MIT is really focused on making sure that we can have a resilient system, that we could do the number of transactions that we need to do at a speed that it would be a viable program. Now, I would say the Boston Fed is also doing the Fed Now program, which is a real-time payment system that provides basically instant funds. It's banks are their endpoint, so it doesn't solve the problem for the unbanked sector of the U.S., but it does provide a number of the use cases for digital currency. So I think there's strong synergies between what we're doing on Fed Now, which is making it easier to do 24/7, 365 days of the year payment system that once it's gone live, which should be in 2023, that it will handle many of the issues that I think a digital currency is designed to do. I do think that the unbanked sector is probably the sector that, unless there are institutional changes in the banking system that provide no transaction fee, no cost bank accounts that could have a digital wallet that would combine with the Fed Now, we wouldn't get to the unbanked part of the US economy. And that's something that a digital currency could do. I think we have to explore other areas that we want the digital currency to do and ask ourselves whether it can be done by Fed Now with some structural alterations, or whether we need a digital currency. There are lots of work still to be done, and I would highlight the cybersecurity issues, the BSA, AML issues, and making sure that terrorist financing isn't done by these instruments. All requires a fair amount of more work, but I think a lot of the work really needs to happen on the policy side, to understand what the side effects would be. And there are potential financial stability concerns with having instant payments. And that's true whether you use FedNow or whether you use a digital currency. So in a world where you can remove funds very quickly, the ability to run on organizations and move your funds quite abruptly does mean that we may be experiencing more volatility both at financial institutions and in financial markets. So I think we have to go into this with some thoughtful ways of considering how it's going to affect the markets and institutions that are currently there. But I also think we're making some great progress. We're going to be coming out with a working paper, hopefully relatively soon, that's going to highlight some of the technical issues that we're overcoming. And the board is working on a policy paper that's going to focus on some of the policy issues, and that should be coming out over the course of this summer too.
Thank you. I'm having difficulties, but a mutual friend, I'm sure, Dick Berner, wanted to ask you for your thoughts on CCPs and the risks and benefits. And, you know, we haven't talked about the Treasury market, but it faced big problems last March as well. There's talk about standing repo facilities. There's talk about central clearing for Treasuries. Do you have any thoughts and views on those issues for us?
I do. As you point out, the Treasury securities market was badly disrupted. The Treasury securities market is the backbone for our entire financial system. And so it's a real problem if we can't be confident that the Treasury securities market is going to operate and that people are going to be able to trade in some volume without dramatically affecting the price. As a result, I do think that we need to think about a variety of changes to the Treasury market. In the long term, I think we should be thinking about structures that are far more robust than what we currently have. To implement central clearing, there's a lot of that's not going to happen right away, but I think we should be moving in the direction towards central clearing. In the shorter run, I do think it's important to think about making sure that the financing of Treasury and MBS securities actually is likely to occur without disruption during financial periods of financial disruption. So I think there's more work to be done in that area. I'm pretty confident that that work will be getting done. And I think that is a good start, but it's certainly not a finish. And I think having more of a central clearing for the Treasury market would be advisable, but it will take quite some time to get to that point.
Well, thank you for that. You know, inevitably in any conversation with a Fed official these days, the question arises about climate finance, the Fed's role in that. I was wondering if you could tell me how you see that. And as somebody who's been a bank supervisor, how much of a risk this poses to the system?
I think this is an important area to understand more. So a critical role for bank supervision is to understand the risks to the banking system. And some of those risks are of short-term nature, some of those are of long-term nature. And it is important to think about, I mean, many of our most important cities happen to be on coasts. And so with global warming, with changes in weather behavior, I think we have to be aware that if banks have a heavy concentration both in their processing and in their lending to areas that may be susceptible to changes in climate, anything from mudslides and fires in California to hurricanes in Miami to flooding in Houston, all these kind of problems are things that are a natural risk management decision that we should be making. The insurance industry has had to deal with this for some time. They've been pricing the risk of changing climate and changing risks. I think the banking sector has been a little bit slower to think about how over time this is going to affect their portfolios. So I think it's a very legitimate area for bank supervisors to be thinking about. I think it's a very different stress test than we're thinking about when we think about the normal stress test, because most of the climate change activity is taking over time and is really tied to events like fire and hurricanes, tornadoes. And so I think those are getting priced already in the insurance market. We need to integrate some of the good thinking that's being done in the insurance market into the banking sector. And I think it's a very legitimate area for bank supervisors to be thinking about, talking about, and board of directors of any large institution is going to have some aspect of their activity at risk, and they should be aware of those risks and be thinking about how to mitigate it.
Coming back to some of the original discussion, let me try and rope in two thoughts together. Over the past years, the Fed has undertaken a number of actions. Some people call it recalibration or tweaking. Others say it's death by 1,000 cuts. I was wondering if you had a view on those directional measures, and then the other thing that somewhat surprised me this year was the fallout from the Archegos incident, and it seemed that there was high leverage in the system, and I was kind of just wondering whether you thought there might be a regulatory or supervisory failure there, in that we didn't have proper oversight over leverage in the system.
Yeah, let me start with the Archegos first. So one of the challenges is not only do we have a fragmented regulatory system in the United States, but there's also a fragmented system when you think about global entities that can operate around the world. And so one of the challenges that Archegos highlighted was that the main players were not exclusively foreign, but many of them were foreign. And many of the activities were being booked out of the US market, but they weren't being booked in the US, they were being booked in offshore to the United States. So what this highlights is that an activity of an institution that may be located in the UK or Japan or some other place may be taking some pretty significant risks that they're able to take in the US market. And depending on how they're booking it, it may be very hard for a bank supervisor. If you're booking it outside of the United States, it probably isn't going to get a lot of scrutiny by US examiners. And depending on the examiners in the home country, it can be very challenging to see these activities, particularly if you're not as familiar with the financial markets in the United States. So I think it poses a significant challenge to think about how we supervise global entities. And I think there's more work to be done on that. Certainly the kind of leverage, not all of the banks took large losses. Some banks took large losses. Some banks were able to exit the position relatively quickly. I think the lesson from this is, one, taking large concentrated leverage position should always be looked at. Prime brokerage is a risky activity and probably deserves a fair amount of attention. Some of the foreign banking activities in the United States are now being supervised in our large bank portfolio and not our large complex bank portfolio. That would mean that it may get a little less attention if they have a prime brokerage than they otherwise would. So I think there are some lessons for the United States, but I think there's some lessons for international cooperation and thinking about global entities in a global way. Given the turfiness of bank supervision, which I'm quite familiar with over the years of being in bank supervision, I think that's challenging, but I think we need to overcome it, because otherwise there are significant risks that are likely to come from global players who are in effect trying to hide the risks that they're taking by shuffling assets around the world.
Well, time is running short, so I'm going to ask two quick questions. The first one, I'm sure a mutual acquaintance of ours, Paul Sheard, was asking just whether you detect any interest in Congress in addressing some of the deficiencies in our macroprudential framework.
it doesn't seem to be at the top of the list of things that need to be done. And I think one of the lessons from the financial crisis, many European countries viewed it as a financial stability problem. The United States viewed it as a too big to fail problem. And so the United States tried to deal with too big to fail and the fiscal risk, but didn't really deal with the financial stability risk. I think other countries may not have dealt enough with the too big to fail, but did deal with the financial stability issues more coherently. So I don't think there's been a lot of activity in this area. I think it is an area that deserves more activity.
Thank you. Well, the last question I have saved for last, but it's the inevitable question you probably expect every time you speak publicly. You mentioned earlier a strong U.S. economic outlook. Some say there's slack in labor markets, others say they're tight. Prices are up. We have this debate about tapering and transitory versus persistent. Would you like to offer us just your general take on this situation?
This isn't a short answer, but I'll try to give one anyway.
We've got 5 minutes.
Well, as you highlight, the recent inflation numbers have come in certainly higher than our 2% inflation rate. We had a total PCE that came out today at 3.9 and a core PCE at 3.4%. That's obviously above 2%. My own view, though, is that more than likely, this isn't likely to be a continuing problem for next year and the year after. So if you look at the trim mean, it's at 1.8%, which is under 2%. What that tells you is large outliers are accounting for most of that movement. A good example is used car prices. As a result of the chip shortage, it's hard to get a new car, and the new cars that are available tend to be the high-priced ones. So as a result, people have turned to the secondary market, and those prices have skyrocketed over the last 2 or 3 months. That's not going to persist over time. Once the chip shortage is gone, the secondary market for car prices will go back down. And I think there are a lot of other markets that are like that. Some of the pricing that we're seeing is also repricing from the lows of the pandemic. So if you wanted to get on a plane, be in a hotel, or rent a car, 6 months ago it was really cheap. Doesn't seem nearly as cheap right now. That's partly a result of the fact that they've normalized their pricing. So it looks like a big increase right now. But if you look at over a longer period of time, it's really recalibrating to what was a more normal price structure. In terms of the labor market, I do think there is significant slack. So if you look at the employment population ratio or the labor force participation rate, and particularly if you break it out by age cohort and gender, you see, depending on which age cohort and gender that you're looking at, a decline anywhere from 2 to 4% relative to where we were in February 2020. That's a big number. That means there's a very substantial amount of labor market slack. Now, some of that is because this was a public health crisis, and many people are not comfortable yet going back, particularly to situations in hospitality, for example, where you might have to be dealing with people that may not be vaccinated and are not wearing a mask. And so for public health reasons, maybe because you are worried about putting your children who can't get vaccinated into childcare, there are a number of reasons why people have pulled out of the market. But I think there's no doubt that there is a lot of labor market slack. If you look at inflation from the perspective of private sector forecasts, if you look, for example, at the Survey of Professional Forecasters, they have a PCE forecast for next year of 2.2 and a core PCE of 2%. That's very close to what the Fed had. So the private sector is close to the Fed on where their inflation forecast is. That's very consistent with the trimmed mean, which throws out the outliers, saying the body of the distribution's not moving. What's changed is there are a lot of outliers. Finally, we have a 10-year Treasury rate that's trading around 1.5%. You don't trade at that if you think that inflation's going to be 3 or 4%. So I think there's a lot of hype around inflation right now. That being said, I do think we're very quickly moving towards full employment and a sustainable 2% inflation rate. We're not there yet. As I mentioned, I think we're going to have GDP growth around 7%. I think it's quite likely that we have a much lower unemployment rate than 5.8% by the end of this year. So I think it's certainly time to start thinking about how quickly is it appropriate to remove accommodation. I do want to get the labor slack taken care of. And I do want to make sure that once we see prices more normal, that we're at least at 2%. I think that will be the case. But we could probably use a little bit more data before we actually make that decision. Nonetheless, I do think we have to look at some of the side effects too of our policies. And as I mentioned earlier, I am worried about housing and other sectors. So I think we have to factor all these things in. I think the FOMC does factor all these things in. You can agree or disagree with where we come out, but I can just highlight that all these issues are issues that are topics that we bring up, and various people provide a wide variety of views. So I think there's been good discussion at FOMC meetings around all these issues.
Well, thank you. You've left us much food for thought for the future. I thank you. So this brings OMFIF's Fed Week to a conclusion. We've had a raft of first-rate and excellent speakers, including many of the Fed's finest, such as yourself. And we thank the Philadelphia Fed for providing special support for us for this week. We thank all the speakers. I thank the audiences for joining us. And in particular, I want to thank Eric Rosengren for his outstanding presentation and discussion. We've all benefited tremendously from your wisdom and intellect. Thank you greatly for joining us today.
Thank you very much, Mark. I enjoyed our conversation.